Welcome to yet another session in financial accounting. We'll be learning ledger accounting and double entry bookkeeping. By the time we're done with this chapter, we should be able to apply and explain the principles of double entry bookkeeping. We should be able to understand the concept ledger accounts. We should be able to prepare nominal ledgers, also to prepare bookkeeping entries for the income and expenditure, and finally be able to prepare bookkeeping entries for assets, liabilities, and capital. So we'll look at the double entry bookkeeping and the preparation of the ledger accounts. So ledger accounts and the division of the ledger. Now, in simple terms, a ledger account is simply a book of accounts. These are principal books for filing, for recording, for totaling transactions by account. So all these accounts that are posted to the trial balance, firstly, we first start by having a transaction. We record them in the ledger accounts, then we balance the ledger accounts, then we post them to the trial balance. After the trial balance balances, we use that to come up with what we call an income statement, and later on post to a financial statement, which is a balance sheet. So I'll be so basic. Firstly, I've explained the accounting equation that we did in the previous lecture to say assets must be equal to equity plus liability, and equity in this case we're talking about capital. And so if we take the liabilities this side, so when we subtract our assets, we remove our liabilities, what we owe. What we remain with is called our equity. This is what we call our accounting equation. So if we're given transactions as follows for a new business entity, where we are told that company AV or commenced by introducing 1,000 kwacha cash. They bought a motor van for 400 kwacha and obtained a loan of 1,000 and purchased goods for 300 cash and sold goods on credit for 400. So we're supposed to use the accounting equation to illustrate the position of the entry at the end of each day. So we understand that the accounting equation says our assets should be equal to equity plus liability. So we need to observe the duality concept to say for every credit entry, there should be a corresponding debit entry. So we're going to look at these accounts using a T account. So a T account looks like this. So we'll be using what are called nominal ledgers, where we'll be containing all accounts that will be posted to the trial balance. So for a layman, I should explain to say, whenever we're dealing with the debit side, we're looking at whatever we're receiving. Whenever we're dealing with the credit side, we're looking at whatever we are giving out. So this is how a T account looks like. So in recording a full transaction, we follow the following steps. Number one, you identify the items that are affected in that particular transaction. Also state whether they're being increased or they're decreased. Then decide which account should be debited and which account should be credited. Then check the double entry, whether it is fulfilled. So this is how we do the double entries. So in a general sense, you need to understand all accounts that are increased by debiting. Whenever we are increasing purchases, we debit them. The opposite for purchases are sales. To increase sales, we credit. Expenses, whenever we're increasing expenses, we debit. To increase liabilities, we credit them. Assets are always debited if we want to increase. Then the equity or capital is credited to increase it. So we use the word pairs, PEARLS, to help us remember. So the pair is PEARLS. So all purchases are debited, all expenses are debited, all assets are debited to increase them. Revenues are credited, liabilities and shareholders' equity. Now, a ledger, like has been explained, is simply a record of the transactions involving a particular item. So the nominal ledger is one which contains all accounts that are necessary to summarize an entity. So if we're going to look at this T account here, we'll look at our transactions that we had, which will follow what is called the duality concept. There are about 7 to 10 accounting concepts in bookkeeping. And the duality concept is simply one concept which says that all accounts have a dual ability, dual treatment. It says that if you have a credit entry, there should be a corresponding debit entry somewhere. That is what the duality concept talks about. So in the previous lecture, we discussed the following items: assets as being what we own, liability is what we owe, capital or equity, the money we start using a business with, income, these are our gains, and our expenses is our capital, our revenue expenditure. So we're going to straight away look at the example that we had to coming up with T accounts. Okay, so if we have this worked example here where we have land, buildings, inventory, receivables, so these are assets. They are both mixed. We have current and non-current assets. Then we have payables and bank loan. So we are being required what was the balance of Nadim's capital account as of January 1. Okay, first of all, assets always have a debit balance and liabilities always have credit balance. So do capital. So our land, we're going to give it a debit balance of 200,000 here. Our building, we're going to give it a debit balance here because it's an asset. All these assets in here have a debit balance, so we're going to put them here until we have cash at hand and the balance at the bank. Payables are creditors, always have a credit balance. So this is credit, this is credit, this is credit for capital. Now to calculate the capital, it's simply the difference using the accounting equation, the difference between the assets and the liabilities. So our assets that we have a total assets of how much? 322. And we have our liabilities that have been given there as 257. So when you subtract our assets from our liabilities, what we get is our capital. Now today I'm interested in mainly coming up with what are called T accounts. So we're going to do T accounts for each of these transactions that are showing here. So I'm going to be as basic as possible so that you're able to understand how the posting is done to the trial balance. May 1, started business as a sole proprietor with 20,000 in cash. So here, remember the 4 steps that were involved in coming up with an account, T account. identify the items involved here. We have capital and the cash account. So what are we going to do to the capital? We're going to credit it, because to increase capital, we credit. And what are we going to do to the cash? Cash is the current asset. We're going to debit it. So on the capital, we're going to put 20,000 on May 1. On cash, we're going to put the name capital as 20,000. So this fulfills the duality concept here. Every credit entry, there should be a corresponding debit entry. So this is on May 1. May 2, I want you to participate now. We have pays 15,000 into bank account. What is happening here? When we pay 15,000 into our bank account,
and you debit in, then the bank will credit.
okay. So who's receiving? The
The bank.
And who's
So
giving out?
It's you, so you're debiting from your account.
Okay.
Or it's the other way around.
So
you're supposed to be crediting to the account, but you're giving out.
so we're dealing.
So this is where the confusion comes in with the bank. Is it, how do they do it whenever you're doing, and with the check, when it's money in the check?
Okay. Yes, Chaka.
I feel it's credit because you're giving out, you're moving from the institution and you're giving to the bank. I don't know.
Yes.
And credit is giving and supposed to be on the right. Then debit is you receive, which is on the left.
That's correct. So it is a transaction that is happening within one institution. We call it a contra entry. See. So we are just depositing cash from the till and taking it into the bank. So our cash account is giving out, so we credit. And our bank account is receiving, we debit the same amount. So we go to the bank and the cash account. So cash account, we're going to give out how much? 15 to the bank. The bank will be receiving the 15. Is that clear?
Mm-hmm.
Yeah, so in short, it's the same company, but we're just the money is too much at the till. We're just depositing it into the bank account, into our bank account. So the cash is giving out and the bank account is receiving. May 4, purchased goods on credit from JM 2000. Now, let me make mention of 5 key important things. Number 1, a cash book or the cash account only deals with cash transactions. Now, all cash transactions produce a document called a receipt. Whenever goods are transacted on credit, we use what we call a journal account, which culminates into a ledger account. Goods sold on credit, we have 2 accounts. We have the sales account and the data. Whenever we sell goods on credit, we're selling to somebody on credit. That person who buys from us is called what? Data.
Sorry, Collins, I think we're getting background from Chaka.
Chaka, let me.
Okay, sorry.
Okay, so you can be writing these are very key important things as we go on. We are dealing with 10 important key terms that I want you to know. When you are selling goods on credit, we are dealing with two accounts, the sales and the personal account of our debtor. Whoever buys goods from us on credit is called a debtor. Whenever we buy goods on credit from somebody, that person is our creditor. So if we are dealing with cash, we're dealing with the cash book or the cash account. So whenever we're buying goods, even from Wally, the name Wally is not even important. We're not opening a Wally account. We're actually opening what? A cash account and the sales, unless we are paying our debt or they're paying their debt. That's when you can cancel out the personal account. So if goods are bought for cash, a document produced is called a receipt. Whenever we pay for goods promptly, we're given a cash discount. Cash discounts come in two ways. There's what we call discount received and discount allowed. A discount received is given to us as an organization for paying promptly. A discount allowed is given by us, the organization, for being paid promptly. There is also what is called a trade discount. This discount is given for bulk buying. If we bought goods in bulk on credit, we're given a trade discount. A document that is produced for having proof and evidence that the goods have been delivered is called a delivery note. Whenever we sell goods, we call them sales. Whenever we buy goods, we call them purchases. And so goods that are returned to us after being bought, after being sold, are called sales returns. They are also called returns inwards. A document produced is called a debit note. The other way around, when we purchase goods and we return them because there could be wrong consignment applied.
So, can you just please go again? Like goods that you returned, what is it called?
When we return goods to our creditor, those are called purchases returned because we had purchased and now we're returning. The other term is called returns outwards. Returns outwards. The document produced for returning goods outwards is called a credit note. The document produced for returning goods inwards is called a debit note. And so whenever we are buying goods and we are given transport, that is called a bonus to us. But when we spend transport for bringing goods inwards, we call it carriage inwards. That amount is added to the purchases figure. So if you went to buy goods worth 100,000 kwacha and you spent transport 1 million or 1,000 kwacha, your total purchases will be 100 plus 1, so 101 in total. Whenever we are the ones selling goods and we provide transport for free, the cost of transport is called carriage outwards. That one is an expense that we charge ourselves, we lose out. And so there is also a special term that is called drawings. We're running a business and we decide to withdraw cash for personal use, we call those drawings. Drawings are withdrawals in goods or money for personal use. Drawings reduce capital. So we also have other expenses like wages, expenses on electricity. Expenses generally are categorized in 3 categories. We have what we call administrative expenses, which include wages, postage, telecommunication, salaries. All these are to do with administration. We also have expenses to do with selling and distribution, which include advertising, carriage outwards, marketing, and commission for salesmen. We also have financial expenses like interest on bank loans, interest on just debentures and loans. Those are financial expenses. Now we can go so that we understand what each of these accounts will entail. So May 3, we have purchases, goods from ERD on credit for 3,000. So we have 2 accounts, a purchases account and the ERD account was a creditor. So purchases always have a debit balance and creditors have a credit balance. So we're going to open purchases account and ERD account. So we go here under purchases, we have ERD 3000. So we open ERD who's a creditor, we put purchases 3000. So you know for every debit entry, there should be a corresponding credit entry. This is what we call the duality concept. May 4, we skipped purchase goods on credit from JM 2000. Similarly, purchases account and JM. Who's JM to us? Our creditor. So on the purchases account, we're going to do what? Put JM. On JM account, we're going to put purchases. Now I want you to continue here. Let's go together. Agatha, do 7 and 10. Chaka, do 12 and 18. Lead us through.
Pays wages in cash. So we're supposed to, there's a cash sale because we're paying.
Cash account and
Cash account, and then the wages.
yes, wages account. So we paid wages for 6th quarter. Which account is giving out? Which account are we crediting?
The wages account is giving out.
The cash account is the one which is paying. So the cash account is giving out. So we credit it.
Oh, you credit it, then you debit the wages.
Because we are receiving the service of the wages. A wage is an expense. So remember, so cash account, we are going to credit under wages 6th quarter. Then wages account, we're going to debit cash because we're receiving the service. Correct. Next.
No, sure. Pays rent by check. So rent is an expense. And then the check, you also have to have a check account, right?
A bank account, yes.
Also, it goes to the bank. Oh, yeah, I see. Okay.
So what are we doing to the bank?
We will credit the bank.
Good. Then the rent
is debit.
Why?
Because we're receiving the expenses.
Yes. So we'll go to the bank account, we'll go rent here, 80, good. Then we go to the rent account, we're going to write bank, 8.
So you can't have like an account where you just write expenses. You have to create each account for each question.
Yes, you can summarize them later on, but these ones are tailored. You can summarize the creditors as one account. Okay.
Yeah. Okay.
Okay. Next, Chaka, lead us through the next two. 12 and 16.
12 and 16. So sales goods for cash. So they are going to have a cash account. So the cash account, sales goods for cash. So the cash account is one that receives, so it's debited.
Yes. And the other account is what?
Then you have the sales account. I don't know, goods account, sales account.
The sales account.
I don't know what you can call it. So it's debited.
Exactly. The sales is credited.
Sorry, yes.
All right, so let's verify. Sales to 10, good. And we open the cash account to 10. Already have a cash account. Sales to 10, correct. That is on May 12. Okay. About May 16.
May 16, it has this May 16. So buy furniture for that paying by check. So who buys the furniture? You as an institution?
Yes.
So meaning buying a furniture is an expense.
So furniture account, furniture is what?
Isn't furniture an expense?
It's an expense.
What kind of expense is it? It's a capital expenditure. So you need to vary between the two types of expenditures. We have what we call revenue expenditure and capital expenditure. Capital, when we buy an asset that is meant for use in a business, we can't call it an expense because it will overrate or overstate the profit. Whenever you buy a motor vehicle, furniture, land, those are fixed assets. So you open an account for that fixed asset, you call it furniture account. But when you buy electricity, that is called a revenue expenditure. It's an expense. You open an expense account for electricity and for cash. So you need to understand what capital expenditure and revenue expenditure is. So all assets, they have their account. So here we're going to have furniture account and bank account. So continue. Chaka, continue.
Sorry, I thought I was muted. So meaning buy furniture. So you're giving meaning you are credited, the furniture account is credited. Then the bank account, I don't know.
The bank account is giving out.
The bank.
So we're crediting the bank account and we're receiving this furniture as an asset. All assets have a debit balance to increase them. So we are debiting furniture account and crediting the bank account.
Check.
So on the bank.
So you are getting money from the bank.
Yes.
And the bank gives out the money.
Yes. The bank is giving out. So under bank, we put furniture, 1.5. Then we go to the furniture account. We are receiving money from the bank. Okay, you're coming up so well. Yes. Let's continue. Agatha, 19 and 22. Chaka, 24 and 25.
Sales goods on credit to SP for 580. So we'll have a credit bank and SP. So SP, I think, will be credited, and we're debiting the sales, the credit account.
Good. So we have two accounts, SP account and sales account. Sales always has a credit balance. SP is our what? Our data. We're going to debit SP because he's our data. So sales, we're going to credit 5.8. SP, we're going to debit 5.8. So
Colin, do you have the notes of what you recently said? Like the 10 important points to note?
Yes.
Maybe we have to keep going back to those You could just share them with us.
I'll share them in the group.
Yeah, good.
All right. So we go to the sales account and what? SP account. So here SP is our data. So we put 58. Then we open SP account. SP is our data. So all data have the what? Debit balance 7. We put there, which is 58. Okay. Go to the next transaction. Buys goods for cash 3,900. Continue.
I didn't know that I was muted. So buys goods for cash for 3,900. We have the cash that we spent, and then the goods that we are receiving.
Yes. So the goods, whenever we buy goods, we call them what?
Until expenses.
No. Purchases. Whenever we
So
sell
good
goods,
and assets, not purchases.
when we sell goods, we call them what? Sales. Okay. So when we pay for a good and it has no title, we call them what? Purchases. When we sell goods and they have no title, we call them what? Sales. When we buy goods and they have no title, we call them what? Purchases. But when we say buy electricity, electricity is it's a nominal account. We call it electricity account. But when there are goods here, so to buy goods, we call them purchases. To sell goods is called sales. So here, buy goods for cash, 3,900. What two accounts are we opening?
But I just know there's also a cash account.
The purchases account and the cash account, yes. So we have the purchases account.
Don't you credit the thing?
And the cash account. So cash account is giving out money, right? So what do we do with the cash account?
Since it's giving out, aren't we debiting it?
Whenever we're giving out, we debit the receiver and credit the giver. So cash is giving out. So on cash account, we're going to do what? We're going to credit. So credit cash, 3,900 under purchases. We're giving out money meant for purchases. And purchases, we're receiving the sales goods in terms of purchases, 3,900. The title here is cash. Okay. Let's go to the next. Pay carriage outwards cost by check, 25.
Yeah, it actually starts by fittings for cash, which is 6,600.
Buying.
So the buying fittings, there are two. There are cash, and the fittings are supposed to be. So the cash account in this case is credited. Then the other account for fittings is debited.
Excellent, because the fittings are what? These are our asset. It's a fixed asset. So we're all assets. To increase them, we often debit. So we go here.
But what I don't understand, before you go down, sir. What I don't understand, like on the same day where it says carriage outward cost by check. Because as far as I know, like to say, when we say carriage outward, means you are the one who is providing transport.
Yes.
So how does that go into the fittings? Because you are the one who bought the fittings.
No, it's on the same date here. So we're going to open two accounts again here, the carriage outward and the bank account.
Oh, okay. Okay. So I mean these are two different transactions altogether.
Yes.
Okay.
So here, the fittings account and the cash account. So cash is giving out 600. So we go to the cash account, 600. And open the fittings account. We put cash. We debit it. Why are we debiting the fittings? Because this is a non-current asset.
Collins, just a quick one. So every time you're giving out cash, it's not you're crediting, you're not debiting. Because I thought if you're giving out, then you're debiting.
Whenever we're giving out, remember the principle, debit the receiver, credit the giver. So whenever we're giving out cash, the cash account is being credited because it is giving out.
Credited. So even with the debit, the debit, when the debit is the one who's receiving, meaning
we're debiting
you're debiting.
Yes.
Instead of crediting the debit, it's the other way around.
So we're debiting the account which is receiving. So fittings account is receiving more fittings, like fittings. You know what fittings are, right? In a company.
Yes.
Yeah. So this account is receiving, so we will debit it. This account is giving, we credit it. If we're paying rent.
I took it that credit is removing. I took it that when you're crediting, then you're receiving. Then when you're debiting, then you're removing.
That one happened with the bank. The bank is it goes the opposite narration of what we are talking about.
Okay.
So if you pay his wages for cash 60, so cash is giving out, the wages account is receiving the service for the wages. So here, pays carried outwards. What transactions are we having here?
The pay carried outwards cost by check. So we are going to have.
I'm in class.
Hello.
Yes, please.
So this one, we don't have the bank account and the carried outwards account.
Yes.
So you pay captured. Let's see. Cash, listen, pay carried outwards cost by check. You are giving out 25. So that's credit. You credit the bank. So you credit the bank, then you debit the carriage account.
Yes.
Carriage outwards account.
Excellent. So 25, we go to the bank. The bank account, 25, we say carriage outwards. And we go to carriage outwards, which is an expense. All expenses have a debit. So we go to carriage outwards, we debit 25. You're doing fine so far. Yes. We have 4 more to go in that order. The 2, Agatha, then the last 2, Chaka, in that order. Yes, Agnes receives part payment from SP 330 by check. What do we do? What do we do? So we received part payment from SP 330 by check. So the bank account is receiving 330. Then SP, for him to pay us, he should have been our data. So to increase our data, we debit them, but to reduce them, we credit our data. So here we're going to debit the bank account and credit the data's account to reduce incongruity. So when we go to the bank account 330, we are receiving it. So we debit the bank account with 330 from SP. Then we go to SP account. It was owing us how much? An amount. So SP account was owing us 530. So instead of subtracting 530, the way we do in accounts, we put it on the opposite side so that it will be reducing this amount. So here we write bank 330. Our next transaction, paid carried inwards cost by check. So the check is a bank. It's giving out how much? It's giving out 20 kwacha or $20.
So when you say when you say carriage inward, meaning you're receiving a discount from the product you bought from.
No, I explained what carriage inward is. I said carriage inward is expense.
Within you, I think.
I said carriage inward is the expense that the marketing department or the sales and distribution expense department pays for taking goods outwards. So if, for instance, furniture, Fun City, we go and buy a sofa from there, they will give us free transport. They will be losing out on transport. That expense is called carriage outwards. So they are paying for fuel and everything from their own coffers. So we're going to say carriage, the bank account is paying $20. The carriage inward expense here is going to be debited because this expense is giving us a sale. So the money is coming out, the expense will always debit expenses. So $20 we will debit, we will credit on the bank account, then we'll credit on the bank account, then here we'll debit on the carriage inwards account. So we go to the bank. Okay, since we're paying by check 20, then we go to carriage inwards. It's an expense or expenses. To increase them, we do what? We debit. So of course, carriage inwards is an expense that is usually attached to purchases. Whenever we're buying goods and we've used our own transport money to bring them inside the business, we would add it to the purchases. I'll explain that when we do the income statement. Then we go to May 28, we pay advertising by check $25. So which account is paying out? The bank account.
The cash account, the bank account.
25. We're going to credit. Then which account are we debiting? Advertising account.
So if you have an account for advertising,
yes,
promotion and advertising.
So here we go to 25. We're going to, since we're paying out, then we go to advertising. It's an expense. We're going to do what? To debit it. Okay. Then we also have sales goods for cash 890. Which two accounts are we considering here?
The sales account and the cash account.
The sales account, good. And the what?
Cash account.
Cash account, yes. So sales always has a what?
So the cash account
receiving 890. And what is happening on the other account?
Debit.
We're debiting, yes. So can I call you? I'm in class. So this is what is happening. Then when we go to May 29, sales goods on credit to KM. What is happening here?
The bank account is being affected, isn't it?
Yes.
Yes, the bank account will be credited and then the drawings account will be debited.
No, first on 29, sales goods.
Oh, 29.
For
okay.
8090. So which two accounts are we dealing with?
You debit the KM account and credit the sales account.
Yes. So who's KM?
M is a
Is
data.
our data.
Yeah.
He's buying goods on from us on credit. All debtors, we debit them. Then sales always has a credit balance. So we're going to go to sales. Under sales, we're going to write KM. Sales KM 8,090. Then we go to KM account, who's our what? KM is our
data.
Our data. So KM we put 8,090 kwacha, $20. And finally,
Sir,
mm-hmm.
Sir, is it possible to just have one account for all data?
Yes,
or each data has to have a separate account?
Yes. At the end of it all, firstly, there's what we call, that's why we have 3 ledger accounts. We have a sales ledger, purchase ledger, and general ledger. So you can put them in one account. For instance, all these ones here are creditors. At the end of it all, you come up with one creditors figure. This will be 5,000. This will be called sundry creditors. So you do that at the end. This one is our this one is our what? Our data. So already he has paid 330. So this is the amount after the balance of. We'll add this one under the debtors together with this one. They're supposed to be put together so that you're not confused. Okay, the last.
So what's the illustration when you put data together? You put the company name.
So when you're putting the data together, you can just open a T account here, and you call these ones what? Maybe you call the total. The title on top will be creditors. Okay. So under creditors, we have the accounts we're talking about here. You start putting them one by one in here. So you now put JM in here, JM 2000. So when you go into this, you put JM 2000. The other creditor that we have is who? We have ERD 3000. So you can go to ERD as well. You put them under the same ERD 3000 until you total up your creditors. So that you have just one figure which is attached to creditors, maybe 5,000. Then you're going to post to the trial balance. It's easier like that instead of writing 10 names of personal accounts. So I'll teach you that in our next session. But for now, it's mainly about opening the ledger account. Is that clear?
Yes, it's clear. Thank you.
Okay, so the last transaction here, we withdrew $100 cash for personal use. Which 2 accounts do we have here?
We don't have the professional, that's the drawings. Professional use is the drawings account. Okay. And the cash account.
Excellent. Whenever there's personal use, it's drawings. If it's business use, it's the bank and the cash. So what is happening?
So meaning the cash account is debited. No, credited.
Credited is giving out. And the drawings
then
account.
The drawings is debited.
Okay, good. So 100 kwacha, $100 is given out. Then drawings account, we are going to debit. Good. So this is how we do our T account. So I'm going to give you homework to balance up based on what we've discussed here. I'll send it on the group. So remember to do the T accounts the way we've done them. And tomorrow we'll be doing the balancing off and sending to the balancing off and sending to the trial balance. So you can get a picture of this. Get a screenshot of this, and I'll need this in our next session. Okay, so unless there are any questions, can end here. So please go through what we've done. I'll send the video so that you can revisit what we've done. Okay.
Thank you, sir.
All right. Have a good day.
Thank you.
All right. Bye-bye.